Hey everybody, Christian here with Christian's YouTube channel. I feel like I've been in a lot of conversations recently about investing. It's not even really about investing, it's about a really specific idea in investing that I think is very often misunderstood, and I would like to just add a little bit of clarification from the perspective of statistics. If you're not already subscribed to the channel, please do so, that'd be awesome. So yeah, without further ado, we'll just get straight into the topic. The first thing I want to do is I have a few basics, investment basics written on the board here. I feel like the quintessential YouTube video talks about pretty basic investment advice.
Hey everyone, Stefan here from ProjectLifeMastery.com, and in this video, I'm going to talk to you a little bit about investing for beginners.
Hey guys, so in this video, I'm going over my top 6 stocks for the month of January 2021.
Which is not what I want to do, but by the time you get to this video, hopefully you've seen before that fees are bad. You know, whenever you have to pay a fee on like an ETF, or if you pay like a brokerage fee when you buy a stock or something like that, it just eats into your profits. I've actually done a few simulations. Where's my marker? Here it is. As an example, let's say you contributed $5,000 a year and you were somehow able to make 15% return on that money every year. Okay, so $5,000 a year at a 15% return. Okay, if you're able to do this, then it's going to take you 23 years. 23 years to make $1 million. On the other hand, if you invest $5,000 a year and you're able to make a 14% return, so let's say you hire some sort of financial manager and they charge 1% per year to manage your money, which is pretty typical if you hire somebody in person. So 14% return, 1% less. It's going to take you 25 years to make $1 million. Okay, so the point I'm trying to illustrate here is that fees add up really, really fast. And even if you think, oh, it's just 1%, it's not that big a deal, just consider the fact that 1% in this scenario is the difference between having $1 million in 23 years or $1 million in 25 years. So, you know, that's 2 years of your life that you could potentially enjoy with all that cash if you choose an asset that has a lower expense ratio, if you choose not to hire somebody at 1%. So I feel like people hear this a lot, fees are bad, but I just wanted to illustrate just how bad they are. You should avoid fees at all costs because they'll really eat into your profits. Basic number 2 is that picking stocks is hard. I can't remember the exact figure, but as a student of statistics, I think the number is like less than 1% of stock pickers are able to consistently beat the market. What that means is, you know, something like the S&P 500, which tracks the market as kind of an aggregate, as an index. If you just put your money in that index, in the general market, you're going to make more money over time than somebody who's trying to actively pick stocks. And number 3, holding assets longer is good. So there are many reasons for this. One is that if you tend to hold assets longer, you're probably developing a better habit of picking something that is a reliable asset in the first place and then just not worrying about it, which is honestly like the best way to invest. Once you buy something, you should just like log out of all your accounts and not even look at it for the next, I don't know, 20 years, 30 years, right? Like the more you trade, the less money you're going to make. The other advantage here is that if you hold an asset for 12 months or longer, you're going to qualify for long-term capital gains as opposed to short-term capital gains, which is going to save you a ton of money on taxes when you start pulling money out. So those are the basics, you know, 3 basic things. Fees are bad, avoid them at all costs. Picking stocks is really hard. You're probably not going to be very good at it. And holding assets longer is a good thing, especially in the United States where you're going to qualify for a lower tax rate if you hold them for at least a year. Okay, so anyway, you've probably already heard all of that. I'm sure that there are literally hundreds of YouTube videos that talk about all of that. That's not what I want to focus on. Instead, the big topic for today is diversification. I have found myself in conversations about this many times over the past few months. It just keeps coming up as something that people want to talk about, and I feel like it's something that people misunderstand a lot, at least from the perspective of statistics. So I realize that this looks like a lot of math. Don't worry, we're going to go through it step by step here. So the first thing I want to talk about is what is this first equation here, which is the expectation of two random variables. Now hold on, don't click away. Let me explain real quick. So let's say that you have stock A and stock B. The amount of money or the return that you're going to make in stock A and stock B, both of those returns are going to be somewhat random, right? So one year you might make 10% in stock A and 6% in stock B. Another year you might make 14% in stock A and 20% in stock B. Who knows, right? The point is that X and Y, let's say stock A is X, stock B is Y. You have no idea how much money you're going to make in those particular assets. And so we refer to those as random variables. The point is they're random. You don't know, right? And so the only way we can talk about random variables, if you don't know, what you have to talk about is the expectation of what you expect to make in each of those assets. So again, talking about stock A and stock B here, let's say that stock A is Tesla, stock B is Boeing, right? Well, Tesla's a terrible example because who knows what's going to happen to Tesla. But the only thing you can say about your potential future returns in Tesla is, I expect that I'm going to make 50%, let's say, 100%, let's say, right? Like that's a very natural way to talk about it. So you have an expectation of what you might make. And there are various ways of computing an expectation of what you might make. The formal definition in statistics is just the average, right? So, let's say that you're looking at, again, let's pick something that's more stable, maybe an S&P 500 index. If you look back 70 years worth of stock trading history, an S&P 500 index asset, on average, makes about 10% a year. So the expectation of the return of an S&P 500 index asset is 10%. I expect over time, on average, to make 10%. Hopefully that's clear. So what E means here, what the E stands for, is expectation. Okay, so what I want to illustrate is that when you have two random variables, again, random variable here just meaning, for example, the return of an asset. So how much money you expect to make in a year on an asset that you buy. If you have a sum of two random variables, so you own two assets, right? You own two assets and your total return is the sum of one time plus the sum of the other, right? The expected value of the return of those two assets is going to be cumulative. And what this means is that if I own stock A and stock B, the total return of my portfolio is going to be whatever proportion of my portfolio is stock A plus whatever portion of my portfolio is stock B. The sum of those two returns is going to make up the total return of my portfolio. Okay, so let's say that 50% of my portfolio is stock A. All right, so 0.5 is the coefficient here. 50% is stock A. And let's say that I make, 10% return on that asset in a year's time. So 50% of my portfolio is stock A, and I make 10% a year on that asset. And then I have stock B, which is 50% of my portfolio. And let's say that asset makes 5% a year. Okay, so I have 50% stock A, here it is right here, and 50% stock B. Okay? And stock A makes 10% a year, stock B makes 5% a year. The total return of this portfolio in a year's time is going to be 5 plus 2.5. It's going to be 7.5%. Okay? So you can see how that relates to this because we have 50% of stock A, 50% of stock B. If we add those two returns together, we're going to get 7.5% in a year return on that whole portfolio. So the key point here is that as long as the expected value of your returns in these stocks is positive, they're going to sum together, right? I mean, in any case, they're going to sum together, but at least as long as they're positive, they're going to contribute to one another. So you're making 5% here, you're making 10% here. If half and half, you're going to make 7.5%, right? So that's a really key point to understand, that whatever proportion of your portfolio is one stock or another stock or another stock, all of those expected returns are going to sum together proportionally. Okay, so there's that. Now, the other thing that we need to talk about, I'll leave that up for now and just draw a line. Sorry, this is a bit of a mess, but I'm new to YouTube, so forgive me. I will clean up my act here as we move along. The other thing we want to talk about, right? Because there's two important pieces of a stock portfolio. One is how much money do I expect to make, right? This is how much money do I expect to make, the expected value. I want to know if I expect to make 5%, 10%, however much. How much money do I expect to make? That's the first thing we care about. The second thing we care about is how volatile is my portfolio. So let's say I expect to make 10% in a year, but one year I might have lost half of my portfolio. The other year I might have made 150%. Who knows, right? Or maybe I expect to make 10%, and in one year I make 11%, in another year I make 9.5%. So the volatility of our portfolio is important. If you're young, it's probably not that important because you're putting money away for when you retire, let's say at 50, 60, 70, 80 years old, whenever you plan to retire. So you don't really care if you're 20 years old. If you expect to make 10% on average every year, who cares if you lose 20% one year? It's not money you're going to be spending anyway. But on the other hand, if you're 60 and you're trying to retire when you're 65, you care about the volatility because if suddenly when you go to retire, you have a portfolio that has lost 50%, 60%, that's going to be a major impediment to your ability to retire. So you care about the volatility of your portfolio. So again, there's two things we care about when we're talking about a portfolio. We care about how much money do I expect to make and how volatile is that portfolio going to be year to year or month to month or whatever it may be. So when we talk about volatility of a portfolio, a common measure of volatility is the standard deviation. Again, not to be too mathy, the basic point is is it going to be way up or way down relative to the average on any given year? Is it going to be a little up, a little down? Who knows, right? Point is we want to measure volatility. So in statistics, we have this measure called the variance. We have the variance of an asset. Sorry, my phone is ringing. Okay, let's get back to it. So we have the variance of a portfolio here. And in the same way up here, we had random variable x plus random variable y, right? We have random variable x plus random variable y again. So you can think, okay, I have stock A and stock B in my portfolio. This is equivalent to that. And so we have the variance of the total portfolio, right? Stock A and stock B. Let's pretend like they're the only two assets in your portfolio. The variance of your whole portfolio is going to be the variance of one of your assets, let's say stock A, plus the variance of your other asset, stock B. This is the key point, plus 2 times the covariance of x and y. Now, what the hell are we talking about here? You've probably heard this term before. Covariance is a measure of how two random variables, again, don't let that term confuse you. All we're talking about here, for example, is the return of stock A and the return of stock B. So the return of stock A and the return of stock B, how do these things relate to one another? So if stock A goes up, does stock B go up the same amount? Does stock B go up half that amount? Does it go up 2 times that amount? If stock A goes up, does stock B go down some amount? Does it go down 2 times the amount that stock A went up? This is the question we're asking when we talk about covariance. How do my 2 assets relate to one another, right? So covariance can either be positive, in other words, here's an example here of positive covariance. You have 2 stocks, A and B, right? This is very positive covariance because A going up means B also goes up, right? If this is time, this is return. Okay, so over time, as A goes up, B also goes up, okay? So that's very high covariance, very positive covariance, but covariance can also be negative. Consider that, this is not really, well, anyway, consider that if stock A goes up and stock B goes down, this is not the right way to show this, but you're gonna get the point here, right? This is negative covariance, so this is positive covariance, and this is negative covariance, right? And so what this is showing you is that if all of the assets in your portfolio go up at the same time, all of those assets are positively related to one another. They have positive covariance. Versus if some of the assets go up some of the time, and meanwhile other assets are going down at the same time that some assets are going up, those assets have negative covariance related to one another, okay? So What this means is that if you can pick assets that have negative covariance in relation to one another, your total volatility, so again, remember, let me come over here because I think the camera cuts out. Remember, your total volatility is the variance of one asset plus the variance of another plus 2 times the covariance of those assets related to one another, okay? So if this number here, the covariance number, if this is negative, right, then your total volatility is actually going to decrease. So you're going to get the same return, you're going to get the same expected return, but if they're negatively correlated to one another, you're going to get lower volatility. This is the absolute key point that I want to make here, which is that if you can select assets that of themselves have positive expected value, so they each make money on average year to year or month to month, whatever, but they make money at different times, so when one's going up, the other's going down, then you're going to make the same amount of money overall, but you're going to do it such that you're exposed to less risk, okay? And this is so important because all of us want to expose ourselves to less risk, right? I mean, it's not all that surprising when somebody on YouTube who has a video in a Lamborghini or whatever that they probably rented says, oh my God, I made 500% in the stock market last year. That's not very surprising because everybody is going to get lucky at some point, right? Luck is plentiful. At some point, if you play the game, you're going to get lucky. By the same token, if you go to the casino and you sit down at the blackjack table, at some point, you're probably going to get lucky and win some money. Okay, so we're not talking about luck here because anybody can get lucky. What we're talking about is, on average, how do we systematically reduce risk in our portfolio? And this is the way we do it. We choose assets that have negative covariance so that we can still make the same amount of money, but do it while exposing ourselves to less risk. And so next time you talk to somebody, about their stock portfolio or whatever, the question you should be asking is not how much money did you make, but how much money did you make relative to how much risk you took. Because if you're out there taking a bunch of risk, at some point you're going to lose, right? That's what risk means. If you might make some money here, but you're also definitely going to lose money over here as long as you continue to have it. And honestly, I'm speaking from experience here, because before I studied statistics and really had a sense of all this, I used to trade options a lot, and I made pretty good money, honestly, for a couple months. And it went to my head, and I started being really bullish on my own ability to make good money trading options. But the problem is, it only takes one trade to lose all of your money, right? I mean, if you're playing this game of risk, at some point you're going to lose. And unsurprisingly, I lost, and I lost a ton of money, pretty much all of the money I had made. I mean, my net was basically zero. And so from that day forward, I was like, well, I want to make money, but I want to do it without taking risk. And this is the way to do it. You find assets that individually are expected to make money, but relative to one another, make money at different times, so that you can have the total return that you expect, but a reduced volatility based on the covariance being negative. Okay, so let me just tie this all together. The reason I bring this all up is because, again, we're talking about diversification. What does it mean to have a diverse portfolio? I hear all the time, when I'm talking to friends or whoever it may be about investing, they say, oh, Christian, I have a very diverse portfolio. I own, for example, Apple, Boeing, I own General Motors, I own Nike, Visa, I own Bitcoin, I own Ethereum, I own all of these different assets. I have a very diverse portfolio. The problem is that, statistically speaking, Apple, Boeing, General Motors, Nike, and Visa all move in the same direction, more or less, on any given day, right? I mean, you can imagine that the stock market is up, and so all of the companies are doing relatively well. The stock market's down, all the companies are doing relatively poorly. Not to say that they move exactly together, but on average, in general, all of these companies are going to move relatively similarly relative to one another, okay? So when I hear this definition of diversification, they say, I own 20 assets, I own 30 assets, I own 40 different assets, whatever it may be, and therefore I'm very diverse. To me, that's not the right answer. Owning more assets does not make you more diverse, okay? What makes you more diverse is owning assets that are negatively correlated to one another or have zero correlation to one another, okay? So I have portfolio 1 here, Apple, Boeing, General Motors, Nike, Visa. Portfolio 2, I have some S&P 500 index, this happens to be Vanguard's VOO, and I have TLT, which is an index for treasury bonds, okay? These two assets are negatively correlated to one another. And so portfolio 2, even though I only have 2 assets, for me is more diverse than portfolio 1 because the definition of diversity that I care about is statistical diversity. I care about diversity for this reason, so that I can make the same amount of money, but do so while taking less risk. So next time you're having a conversation with somebody and they're talking about how diverse their portfolio is, ask them, how diverse is your portfolio statistically? What is the relationship between each of your assets in terms of how they move relative to one another? If they own a bunch of American equities that all move relatively similarly, the answer is not very diverse. I don't care if you own every single asset on the NASDAQ or every single asset on the New York Stock Exchange. If it's all related to one another, it's all American equity, it's probably not very diverse. On the other hand, if you own different types of assets, so equities, here's treasury bonds, maybe you own a little bit of currency or gold, precious metals, or something like that, or you own other types of assets that might be, have negative covariance relative to one another, you have a much more diverse portfolio, which is much more important than owning a bunch of different assets. So that's my soap opera about diversification. Hopefully that was helpful. I also want to say, right, because there's a question that I've responded to frequently about this very topic is people want to take this to the logical conclusion, which is that, oh, Christian, if all I care about is the covariance of my assets, then why don't I just buy one, maybe S&P 500 index and one short S&P 500 index, right? Because the definition of a short is that if the market goes up, you lose money. If the market goes down, you make money, right? So one VOO and one short VOO are going to be perfectly, well, not perfectly because of the way it's done, but close to perfectly negatively correlated to one another. So why don't I just do that, right? Why is that not the correct answer here? And the reason is because you cannot consider these two things in isolation. A short portfolio, if you look on the stock market or whatever, I don't have a ticker in front of me here, but you'll see that on average, a short S&P 500 loses money. And that's not surprising, right? Because on average, the S&P 500 makes money. Again, going back 80 years or whatever it is, on average, the S&P 500 has made about 10% a year. And so the S&P 500 short has lost 10% a year. And so if you go out and you construct your portfolio with one asset that makes 10% and one asset that loses 10%, and you do this calculation again, right? You're going to have 0.5 times 10, which is going to be 5, but then you're going to have 0.5 times negative 10, which is going to be negative 5, and your total expected value is going to be 0. Okay, so the key point here, so you're going to expect to make 0% a year in that case, right? And the key point here is that if you consider volatility in isolation, you might pick assets that don't have positive expected value, in which case you're expecting to lose money. And even though your volatility might be relatively low in that scenario, you're going to be basically at 0 return, which makes sense because if you have one asset that's going up and another asset that's going down equal amounts every single day, you're going to have 0 volatility and 0 return. So that's not particularly helpful. And so that is something you should also think about. You should look for assets that are negatively correlated, for sure, but you should make sure that your assets are, even though they're negatively correlated, they have positive expected value. In other words, you expect to make a positive amount of money so that you can take advantage of the accumulation of expected value here and also the subtraction of volatility. Otherwise, you're going to come out with basically 0% expected return. Okay, so I feel like that's my lecture for now. Hopefully some of that was helpful again. If you have questions or comments or anything, drop them in the comments below, or I'll probably put my email or something somewhere, or my Twitter, and you can let me know. The other thing I want to say is that I'm working on putting a website together that explains some of these concepts, and also I'm going to make a little tool that allows you to basically automatically trade on Robinhood. So you can say, hey, I want to basically maintain this portfolio on my Robinhood, and this tool will automatically rebalance for you on any kind of set schedule. So be on the lookout for that if that seems like something that would be helpful for you. And otherwise, yeah, like let me know if there are other topics in finance that you think would be interesting. Again, I'm not an expert by any means. I didn't study finance in school. I don't know, what else can I say? Like, I'm not certified. On the other hand, I did study statistics, and so a lot of this is related to the mathematics of statistics. And so in that sense, you can at least trust that the way that the math works out here is definitely true. Okay, I'm going to end there. Thanks for watching, and stay tuned for the next video, which is going to be about, who knows, maybe flying, maybe finance. I have a knee injury right now, so I might make a video about how to treat patellar tendonitis because it's a pain in the ass. Okay, catch you later.